QuickBooks Pro Desktop 2021, adjust opening balances. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown and selecting the open windows list. In prior presentations, we have been entering the beginning balances. I'm going to go take a look at those beginning balances now. You should have access to this Excel worksheet, but if you don't, that's okay. You can follow along with this as well. We're imagining a situation where we have this information from our prior accounting system that we want to enter into the QuickBooks system as of this point in time, moving forward from the cutoff date of January 1st, 2021, entering data for the year of 2021. Anything prior to that point, we're thinking is going to be in our prior accounting system. Therefore, all we need to do is enter our beginning balances as of this point in time. We've been doing that one by one. QuickBooks sets up a nice little system to do that. What they do is they say, hey, you put in the beginning balance for all of the accounts on the balance sheet, and we'll just dump the other side somewhere, typically falling into the equity account in some way, shape, or form. Therefore, they come up with accounts such as opening balance equity, uncategorized income, uncategorized expenses, and those things all roll into equity. So if we put all these beginning balances in correctly other than the equity balance, then QuickBooks will just dump the other side into equity. Equity as a whole will then be correct after that point in time. However, we then need to go back in, and this is where we are at this point, and adjust anything that's in the equity account to the proper equity account. Now, if we're in a sole proprietorship, that means we only have one equity account that we will have to typically be dealing with, and we'll just take everything that's not in that one equity account and put it into that one equity account. In other words, QuickBooks will dump a lot of stuff into the opening balance equity account, which is a made-up account. It doesn't really matter if you have it in there. It's not going to hurt anything, but it doesn't look professional. So if someone else sees it and they see you have stuff in opening balance equity, they may, look down on it. They may say, oh, maybe they don't know what they're doing or something like that. So you want to take it out of opening balance equity and put it into an actual equity account so that it, just looks better. Now, if you're in a partnership, then of course you have to do this because you will have to be tracking the partner accounts separately. So you'll have to, every time the income rolls into the equity account, you'll have to apply it out to the partnership in a correct fashion. And if you're a corporation, then you have similar kind of things that you're going to need to do for a corporation, but it's actually a little bit easier because it'll roll into what is the retained earnings account. You'll typically have one account it'll roll into, and then the common stocks account. Okay, so the bottom line is that we've entered all this in here at this point. Now we have something in equity. I'm going to highlight this one because this is the one that we want to adjust now at this point. We want to adjust the equity to have one equity account because we're a sole proprietorship. We don't want anything in the opening balances. We just want it all to be in the owner's equity. Let's go on back to QuickBooks and check this out. I'm going to open up our two major financial statements, that being the balance sheet and income statement. If we hit the reports drop down, we're going to go to the company and financials. We're going to go on down to the balance sheet standard, the standard balance sheet. Now, we entered all of our balances as of 12/31/20, That's the date before the cutoff date. So that's the date before we're going to start the new year in January 1st, 2021. If you look at the equity section, then down here, the total equity section is correct, 77,896, but it's not. It's broken out into multiple equity accounts. One of them being the opening balance equity, and then you see this other account being net income. And net income is not really an equity account. QuickBooks is trying to help us out with that net income by showing it on the balance sheet to show you that the net income is linked. The balance sheet is linked to the income statement. They're not two separate things that act differently. They're trying to show you where that link is, but that's not really something that would traditionally be shown on the balance sheet. And you can see that because if I go into the next time period, the month that or the year that we will be working in, 2021. So I'm just going to add one more day. Now that's our cutoff date. That's our starting point, January 1st, 2021. Then it changes that account to owner's equity. That's because the income rolled in automatically by QuickBooks, the closing entry process. If you know financial accounting, they closed out the income statement, the temporary accounts into the balance sheet, and now it names it the owner's equity account. So that's what's going to happen every year. It's going to roll into the equity account. So now we have our starting point, And this is correct, but again, it doesn't look as neat to have this opening balance equity here, so we need to adjust that. Let's take a quick look at the income statement, hitting the reports dropdown, company and financial, profit and loss standard. And we entered all of our information in there as of the end of 2020. I'm just going to do the whole year for 2020, 01/01/20 to 12/31/20. And so now we have this information which is wrong because it's got uncategorized income. That doesn't make any sense. And uncategorized expense. And there's our net income of the $5,500. Although this is wrong, you'll recall that we entered it before our cutoff date, and it doesn't matter because this $5,500 being part of equity is right. So the fact that it rolled into equity as of the cutoff date that we're starting forward is right. This income statement information is wrong, but it's okay because we're not using the QuickBooks for anything prior to the cutoff date. So in other words, if I go into the next year, the year that we are going to be starting and actually tracking in this accounting system, there's nothing at this point in the profit and loss. That's what you want when you start going forward. You want to say the year that I'm working in, there's nothing in the profit and loss as of this cutoff date, and then you're going to move forward from that time period. Anything that's in there prior to that cutoff date, fine, because you're not using this accounting system for that purpose. You're using whatever prior accounting system you had. So that looks good. Now we're going to go back to the balance sheet, and all we want to do now is adjust this opening balance equity, the $72,396, from that account that doesn't look professional to the proper account, which is going to be the owner's equity account. A couple ways we can do this. We could do this with a journal entry. So if you're comfortable with journal entries, you could do the journal entry. This is an equity account. Equity accounts have credit balances. Therefore, to make it go down, we would debit that account, and then we're going to increase this account that's an equity account too, so we would credit the equity account. And if you work with debits and credits, you might want to look at the trial balance to see that. If I go to the reports drop down and we go to the accounting and taxes and we take a look at the trial balance, this is going to be our really useful report, even if you don't really fully understand the debits and credits. So I'm going to say 01/01/20 to 12/31/20 because it lists all of your accounts nice and compactly right here. So that's really nice to be able to see your accounts nice and compact format that doesn't have all the subtotals and whatnot. If you don't understand the debits and credits fully, that's okay because it's still a little bit easier to see both the balance sheet accounts and the income statement accounts. As we'll see down here, you got the income statement accounts. Down here, you could see both of them on one report, which is kind of nice. You don't have the totals, but you can see those accounts. So in any case, now you can see that in the equity section, the opening balance is a credit. So we want to take the opening balance down and put it into the other account. You can also see the closing process here. Notice that this income statement accounts, these two accounts down below, will disappear if I move this to 2021, which is the year that we're going to actually enter data for. I'm going to say enter, and now it stops at the equity and you don't see any income statement accounts. There is no income statement accounts here. So that's going to be, the other way you can think about it is let's say we try to eliminate the debits and credits and just think about it as increase or decrease. We're going to decrease the opening balance equity and increase the owner's equity. And you can think about it that way by using the registers in QuickBooks. QuickBooks provides a register kind of like a check register that you might be used to seeing a check register format for the checking account. They do that for many of the balance sheet accounts so that you can kind of think of it as an increase or decrease. So in other words, I can say, okay, I know opening balance needs to go to 0. Why don't I go into the opening balance account, enter it into the register, and then the other side, I'll just say go to the owner's equity, and QuickBooks will just do the other side and make it go to equity. So let's try it that way first. So to do that, I'm going to go to the register. Here's how you get to the registers. I'm going to go to the lists up. Well, there's a couple ways you can do it, but I'm going to go to lists up top. We're going to go to the chart of accounts, and then I'm going to find that equity account. Now, only the ones that have registers are going to be the balance sheet accounts have registers. Income statement accounts do not. So we're going to go into the register for the balance sheet account. This is an opening balance equity account. So it's got that $72,396 in it. I'm going to double click on it. And we're in the register now. I'm going to make it as of our cutoff, the dates that we've been putting all our information in right before the cutoff, 12/31/20. And then we have increase and decrease instead of debits and credits. So notice we have a balance of 72,396. I want to decrease that to 0. So I'm gonna say decrease that to 72,396, which should take it down to 0 and make the other side go to the other equity account. So I'll hit the drop down or rise up here, and we want to go to an equity type of account, and we want the owner's equity, which is the primary equity account. And then we can say this is just to adjust the opening balance to 0. And then it's going to say, hey, you're hitting retained earnings, which you don't normally do. It's a retained earnings type of account. It's the account that we roll over, that they roll over the income to. And they say you don't usually do something that goes to the retained earnings or owner's equity. We're going to say, okay, that's okay. We know what we're doing here, but thanks for the message. And then we'll go back to the balance sheet. And then if we refresh this, we're going to say, okay, there it is. So now we got it in one account here in the owner's equity. So everything should line up at this point, and we have just the one account down here in the owner's equity, and we have our beginning balances. We're good to move forward. Let's take a look at the trial balance over here just to check it out there too as well. You can see that the opening balance has now gone to 0, and we now have the owner's equity here. Now, if you went the wrong way, if there was a problem with it, then you can double click on either of these. I can go into this and say, give me the detail. I'm going to change the date back to 2020. And then we're going to say, there's the adjustment. If I went the wrong way, if I had the debits and credits mixed up, then I can double click on that. It'll take me here. I'm at the register. If I want to see it in journal entry format, I could double click on this little journal entry section. You got to be over here to get there. And then it takes you to that journal entry page. Now, if you're more comfortable entering it in the form of a journal entry, then you go to the company page drop down, and the make journal entry is right here. And you can come to here directly and enter it as a journal entry if you'd rather use journal entries rather than registers. The basic format that you want to do is say, I want to use form. Right now we're using the opening balances to enter these opening balances. Then when I enter data, I want to use a form if there's a form available to use. And if there's not a form available to use, then I want to use a journal entry, which is the last thing to use, because if there's a pre-set up process to work in QuickBooks, I want to use it. If not, then I go to the journal entry. And if you're more comfortable doing the debits and credits, you can use the journal entries. If you're not comfortable with debits and credits, you can think about it in a plus and minus format with the registers. The registers, however, aren't quite as efficient, because if you have a long journal entry, it's going to get confusing to have things going increase and decreasing. And if you have contra asset accounts like we saw with the accumulated depreciation, it can actually be more confusing. But if you only have 2 accounts affected and one of them is an balance sheet account, which will have a register to it, then you can think about the increase and decrease of one account, and the other one will just do what it needs to be done, and QuickBooks will record that transaction for you. So that's how we'll proceed with entering the transactions. That's the format that we will do. We'll first think about, is there a form that we can use? If it is, we'll use it. If not, we'll do the journal entries. And when we think about the journal entries, we'll show both methods, but we'll try to use the registers when it is appropriate, when it doesn't become too confusing to do so. And when we have long journal entries or areas where we can't use the registers, then we'll go to the journal entries.